All right, well, welcome everybody. This is David, and I'm your host today on this exciting emergency marketing webinar for mortgage professionals, talking about how to generate more incoming leads into your business and how to leverage specific niche products. We have an exciting, fast-paced 30-minute webinar that's going to be talking specifically on strategies to target high-rate and or mortgage insurance borrowers who can still benefit from refinancing. Stay tuned. You're going to have a lot of information and ideas over the next 30 minutes. We're going to go ahead and jump right into our presentation. So if you're multitasking, we're going to ask for your undivided attention. We've got a lot of specific sample marketing strategies that we're going to show you on the screen, and we want to make sure that each and every one of you sees those and you can ask questions about them. This is going to be an interactive webinar, but the phone lines have been muted to protect the call quality. We're going to go ahead and take Q&A through the GoToWebinar control panel over there on the right-hand side of your screen. Today's panelist and presenter is Jeff Bush. He's the president of OverflowWorks.com. He's got 20 years of direct marketing experience, and he's done over 1 billion direct mail pieces for the mortgage industry. He actually owned a mortgage banking company that closed over 5,000 loans, $1.7 billion in production from 2000 to 2007, and he did this leveraging direct mail as his primary lead generation tactic. So Jeff is an expert not only in the direct mail industry, but also in being able to create clever and unique high-response marketing campaigns to get more incoming qualified leads to call you inside your mortgage office. So Jeff, welcome to the webinar today.
Yeah, thanks for having me, Dave. Excited about it.
Well, talk a little bit more about your background, Jeff, in terms of direct marketing in the mortgage industry and why you think today's marketing strategies are really what a lot of mortgage brokers and originators are looking for.
Well, I've got a background of doing direct mail for mortgage companies for like almost 20 years now, and then owning a mortgage company for 7 years. I mean, I kind of have both sides of the fence, you know, the marketing and knowing what it takes to get a loan funded. So I've got kind of a unique insight in some of the data that we market to and some of the calls that we generate to try to, you know, make the phones ring with qualified borrowers that can benefit from a refinance, and, you know, understanding all the nuances of the mortgage business with, you know, mortgage insurance and at different rates and different times and LTVs, and just really understanding how to put a good database together and market a good borrower that can close is, you know, just some of the expertise that I have that, you know, you might not find at another person that just knows how to do printing and mailing, you know, some insight on the lists and the data.
Well, we promoted this particular marketing webinar as an emergency marketing webinar, and we've had a huge jump in terms of interest rates, going over 1% in the last 45 days. Now, you've got over 100 different mortgage companies that are marketing with you in over 39 states. What are you doing with your marketing to help these marketing clients keep funding refinance loans in this increased rate environment?
Well, my business as far as marketing for mortgage companies is so closely tied to what's happening in the mortgage market that when the mortgage business changes, obviously I have to change to keep bringing qualified calls in that can benefit from a refi. So whenever we're in a crazy market like we've seen in the last 45 days, rates jumping over a point, you know, it's important to be able to change gears. I mean, 3 months ago, I was mailing 1 million pieces a month, all for FHA and VA Streamline, you know, 60 or 70 different clients around the country. And when rates did what they did, I mean, that ended pretty abruptly. So now we're tasked with trying to find a group of people that is paying higher rates, you know, preferably over 5.5%, and you know, but they have enough equity or they have, you know, the guidelines that are needed to fund those loans. So, you know, we've just gone to work really hard in the last 45 days, you know, finding lists that are responsive and can still qualify for a loan. So we're going to show some of that today and what we found and developed. The big thing is just finding people that are paying higher rates, and it's a smaller group.
Well, talk a little bit more about this screen that we're seeing now, Jeff, and this chart of this amazing growth in these high-growth markets.
So what we're looking at here is just a chart for the highest, you know, growth as far as property values by city or metropolitan area around the country. And I think it's important to look at this. I mean, depending on what state you're in and where you're licensed, you know, Phoenix, Arizona is up 47% year over year. I mean, a year ago, you know, sales prices were, you know, like in the mid-100,000s, and now we're at 243. So whenever you have rapid growth like that, you think about these people that bought a home a year ago using an FHA loan, putting 3.5% down. Now they've got 20, 30% equity. So there's so many options for these people to refinance. So we look at this chart and look at the top growing areas. You've got Arizona, Florida, Nevada's up 32%. So if you're in these states, obviously you've got a huge opportunity to help these borrowers lower their rates, give them cash out to pay off bills or fix up the house. Certain areas of the country, North Carolina, one city, county up 30%. I mean, this is in 12 months. So I just thought it was kind of interesting to look at this report and look at some of these cities. Typically the cities in states that shoot up in value tremendously, they also come crashing back down and then go up again. So it's totally different in the Midwest. Some of the Midwestern counties and states you're seeing might have 3, 5, 10% growth year over year. But if we market to some of these people that put 3.5% down on their home 2, 3 years ago, there's a lot of them have 20% equity and can get out of their FHA loan into conventional. So just kind of an interesting chart to look at the top growing areas in the country, all the way down to, 3 or 4% year over year growth. At the end of this chart, you'll see some of the Midwest, cities and counties that don't have the huge, ups and downs of property values like California, Florida, some of the West Coast and the East Coast, I guess.
Now, this is an article that was published in a trade publication, and you can email this particular article to those people who are interested in knowing about their specific state. Is that correct?
Absolutely.
Great. Well, talk to us a little bit more about the FHA conversion chart that I'm showing on the screen right now, Jeff. Break down a little bit more about how this is playing out with some of your marketing clients.
So what this is just a list of people that we have their mailing address and their mortgage information. All these people have FHA loans that are $150,000 or higher loan amounts. They're FHA loans that were opened 12 to 48 months ago, so in the last 1 to 4 years, and they have 20% equity or better in their property, so they're perfect candidates to market to and get them out of their FHA loan, put them in conventional, and eliminate their mortgage insurance. So these are just counts by state. We also looked at historical interest rates from FHA by month and by year, and we're really focused on the 30-year fixed rate loans that are over 5.5%. There are some adjustable rate loans in here, but it's pretty small. That would be in the mid-4s, but I think those are still good people to market that might want to go from adjustable to fixed. So these are just specifically FHA loans that we can market by state that have equity.
Well, how about in terms of just giving a sample? I'm going to bring up a screen here that kind of shows some of the sample data that you provide. Walk us through this data, Jeff, and how mortgage professionals can leverage this to market to specific buyers or specific qualified candidates that need a refinance mortgage.
Yeah, so this is some live data out of our database. The first person is at Amicar, I guess was their first name, in the city of Manassas, Virginia. They funded a loan with Embrace Home Loans for $285,000. It recorded November of 2011. We're estimating their interest rate to be 5.5%. So we're showing in the data, and all this data, of course, gets printed on the letter, what their old payment would be, $1,621, plus their mortgage insurance based on particular MI rates for that year. And then we're adding it up, showing, hey, this person, estimating their payment to be $1,918. If we could do a new refinance, I think we built this around 4.25% or 4.5% rate, showing them a new payment without mortgage insurance, and then showing them what they'd save monthly on their payment, and then taking that times 12 and showing them their yearly savings. So all these fields in the database get printed on the letter, and it just makes the letter respond better because we have a personal offer for them. We're using their loan amount, estimating their old mortgage payment, their new one, the monthly savings, the yearly savings. So these are some of the extra steps we take to try to increase the response on the mail. And you can see all these people with loan amounts in the mid-200,000s are saving, $400 or $500 a month. And, they're not all like that. Some of them will save $250, $300, but enough to make it worth them moving forward with the refinance.
You've also supplied us with some average interest rate for FHA insured 30-year fixed rate mortgages. So walk us through how you're leveraging this information to target more qualified borrowers.
Well, nobody has real interest rates on their file on a 30-year fixed rate mortgage, which most FHA loans are obviously 30-year fixed. If they have an adjustable rate loan, they sign a rate rider with title, and we actually know exactly what their interest rate is on an FHA adjustable loan, but most of these are fixed. So we use this chart to estimate what interest rates were, and this chart comes directly from FHA, and what it's showing you is, the average FHA interest rate by month and by year. So if you look at, 2009 average interest rate, it shows, by endorsement month, January through December. But if you look off to the far right, you'll see the average interest rate for 2009 was 5.63. So most of those borrowers can take advantage of lower rates, but more importantly, the ones that are after June of 2009 that don't qualify for the MI reduction, these people, a lot of them have enough equity in their house where they can get out of their FHA loan altogether and move to conventional and save them that mortgage insurance. So 2009 was 5.63%, 2010 average FHA interest rate's 5.23, and then 2011 is where we saw it start to drop, 4.66, and you can see 2012 the average interest rates were 3.97. It shows how many FHA loans funded in that year, and this is directly from HUD. This is a report I downloaded off their website that you can find out there. And of course, it removes any HECM, reverse mortgage loans out of here. So it wouldn't be a fair sampling. So we use this chart to go after the months and the years where rates were high.
You're also targeting those who are paying mortgage insurance, and so maybe break down this chart in the same way, Jeff.
So here's another chart that we look at to figure out what they're paying in mortgage insurance. If they took their loan out in 2010 before October, it looks like it was 0.9 was the mortgage insurance, and then April of 11, their mortgage insurance went up to 1.15, and then 1.25 for jumbo. So you can see that when the mortgage insurance increases happen, and again, this allows us to target the data a little bit better to calculate their loan amount and what their mortgage insurance payment is, so we can show it on the letter and show them getting out of that mortgage insurance and then have, a pretty close number. These aren't 100%, but using all these charts for rates and, when MI went up and what level MI was at different, years and months, just allows us to produce better data and a better mail piece more targeted to their specific loan.
Well, let's just go ahead and jump in and show them one of your high response direct mail pieces. Now, you've obviously gotten permission to share this particular document, or is this something that you use exclusively with your clients in different markets, or how do you handle exclusivity, Jeff, or custom letter creation?
Well, we only sell the data once to one client. Once somebody mails our data, they've got an exclusive on it for like 90 days before we'd open it up to for somebody else to mail. I mean, our goal is that a client that calls us and mails with us, we want them to get as many calls and close as many loans as possible, so they'll come back and reorder with us. So I'm not in business, selling the same data to 5 different mortgage companies. That would just hurt their response and hurt my chance of getting a reorder out of them. So the data would be exclusive for 90 days. And I'll tell you, whoever jumps on these things first tends to get the biggest response. I mean, when I first started doing FHA Streamline mailer ago, we were getting 1% response, and then as more and more mortgage companies came in, and mailed that data from other companies and other direct mail houses, response rates dropped from getting 1% response all the way down to getting 0.25% response. So whoever seems to jump on these things first gets the biggest response rate, funds the most loans, and the people that wait, as months go by, these lists become less responsive because of saturation, just too many people mailing them.
I think that's one of the benefits, Jeff, of having you as almost like a marketing consultant for some of these brokers and larger or mid-sized mortgage companies, is that they can benefit from your expertise and they can jump on what's hot and what's not, or back off of what's not before they dump a bunch of money into something that's just have been burnt out. I'm going to do a poll right now on just what is the current level of production inside your organization. If you're an individual originator, you can put down your own individual number. If you're a branch manager or owner, go ahead and put in the total volume of your business, just so I could share those results with Jeff. and he can talk specifically to the participants that are on this call. Go ahead and cast your votes. I'll terminate the poll in about 5 seconds. Jeff, do you want to talk a little bit more about putting in specific variables and just how that generates a better quality call, and how you've been able to manipulate that just so that it looks so personalized that when an individual gets that letter, it feels like, hey, they're getting something of true value, and it's showing them exactly what they need to do to take that next step?
Well, what increases the response rate on direct mail is making the offer, the more personal, the more one-to-one you can make it, the more attention you're going to get from that prospect and the better chance you have of calling. And little things we can do on the letters could take, if you mail 10,000 letters, and you get 0.5%, 50 calls, sometimes adding some of these elements to the letter, to the data, and personalizing the letter could, jump response rates as much as double. You can get 100 calls, a 1% response instead of 50. So we just do all we can to try to maximize how many calls they're getting. And a lot of times when these borrowers get letters that are just generic, like a generic postcard that just says, call now and save on your mortgage and has a big interest rate, or streamline refinance, it's just they've seen that offer before, so you've got to get a little bit more specific and creative and show them something that that's really going to get their attention based on their loan amount, their mortgage. So, you can see on this letter, if your mortgage balance is around $285,000, you could be paying this payment, and here's what your new payment could be and how much money you're going to save per month and per year. Those are those data fields we went through that are all personalized into the letter. And, I can save $6,168 a year on my mortgage payment. I mean, that's a strong offer. So we talk about direct mail is all about the list. Everybody knows the list is crucial, but just as important as the list is what offer you're making to that list. So this offers a really strong offer to a great mailing list, and that's what makes direct mail a win.
We've blocked out the client's name and the contact information with the disclaimer information down below, but talk a little bit more about some of the different compliance customizations that you can do, and maybe some of the larger lenders. You've worked with top mortgage companies around the country, so you've worked with some of the big players and gotten your marketing approved. How difficult has that been for you to get your marketing approved?
Depending on the company, what's interesting right now is it seems like all the compliance and legal are so worried about CFPB and, Department of Real Estate, and you've got to comply with all these rules. But at this point, I mean, I have probably 50 letters that have been approved by really large mortgage lenders that have gone through legal and compliance. So I've got a pretty good benchmark to start with. Sometimes compliance people, legal, it's all about opinions, and they have different opinions and want certain things done. So we just work with, our department creates mail pieces that are compliant, but we always run them by, your legal, your compliance. They might have little changes they want to make, a different opinion on something. So
it looks like that the two sample letters, this is the second one that was sent to Las Vegas resident. It looks like that the letters or mailers that you're using, Jeff, are snap packs. Is that the most commonly used strategy, or are you seeing some window envelopes still being leveraged?
Our business is probably 60% letters and 40% snap packs. I mean, the snap packs are, similar in price to letters, and I think they get similar response. I personally don't believe that whether you mail a snap pack or a letter is going to make the big difference in the response. It's more about what list you mail into and what's your offer. I kind of like the snap pack because I can personalize both sides of the letter. So on the outside, we've got on here, reduce your mortgage payment by, $7,000 a year. So that gets them to open it. So that's a pretty strong message to get the mail piece opened. But we still do more letters than snap packs. Just the samples we ended up having today happen to be snaps, but they're all highly variable. We personalize their city. Las Vegas residents, lower mortgage payments through recent, increases in property values. So every city name goes in there variable. Henderson, Nevada, Las Vegas, their city, so that kind of recognizes and personalizes it to the city they live in. Their loan amount, their loan date, their payment, showing a new payment. So these are some of the things, again, just to get a better response. And when they call, they're pretty educated about what they want. It makes it a little easier on the loan officer to move them into an application and hopefully just finalizing a loan.
Now, Jeff, you've been one of the the unique marketing companies to actually leverage physically handwritten marketing letters. Talk a little bit more about the effectiveness and the increase in cost and how different the ROI is.
Well, an average direct mail letter in an envelope, mailed third-class mail with a printed indicia or maybe a third-class stamp runs around 60 cents a piece. A hand-addressed envelope, has a 49-cent stamp on it, so just the postage stamp is 49 cents. So these handwritten letters and hand-addressed envelopes, and these aren't done on a computer or machine, that we literally have, 40 stay-home moms in San Diego County that literally hand-address every envelope, fold the letters, put it in, put the stamp on. So it's a full manual process. So these handwritten letters can be anywhere from $1 to $2 a piece, depending on what level of handwritten and whether you use a 39-cent or first-class pre-sort stamp or a 49-cent stamp. But one thing we've noticed with these hand-addressed envelopes, we know that they get opened. So when I really push a hand-addressed envelope in a letter is when you have a real small database and you want to get a huge response out of it. You might only have 1,000 or 5,000 people to mail to, and instead of getting 0.5% to 1% response, we want to try to get 2 or 3% response. So the hand-addressed envelope is a great option for a real small list.
So you've also used these in terms of follow-up to leads that had come into maybe a larger mortgage company that had some individuals who maybe didn't proceed. Has that been a continued strategy leveraged by your clients, or is that just more of a unique circumstance?
Yeah, some larger mortgage companies have sent me databases of a couple thousand people that maybe have called into their office and didn't convert into a loan, 3 months ago or 6 months ago or 2 years ago, and they really have a small database that they want to get a huge response rate out of. So we do the handwritten letters and make them more personal, and it always jumps response from usually double to triple response rates on something like this. Great.
Any other final comments, Jeff, in terms of the comparison table that we're showing here?
Return on investment, the worst mailers we do drop down a little bit under 0.5% response. We've had some people get, 0.4, so 40 calls on 10,000 mailers. And, if they close it, was that 15% closing ratio, they still fund 6 loans for $6,000. It's $1,000 a loan to get a loan closed from marketing. That's kind of worst case. And then best case, 1.5% response with a 20% close ratio. So it kind of shows the range of what you could expect, return on your mail campaign. A lot of it comes down to, who's taking the phone calls, how are they on the phone, what's the, what rates are you selling, what fees. There's so many things that go into conversion. Are you answering all your calls? But we usually see anywhere from a 4-to-1 to a 20-to-1 return on investment. Our average is probably 7-to-1 nationally. So, but the more targeted we can get on the list, better response, better return on investment you're going to have.
Great. Well, let's move on to non-owner HARP. You've got some tables on breakdowns of count. You've been doing some marketing to non-owner HARP leads and actually producing a direct mail campaign that has a guaranteed rate of $100 per call. Talk a little bit more about that, Jeff.
Well, again, with the market changing and trying to find people that are paying higher rates, we came into, non-owner occupied loans where the average interest rate on a 30-year fix is about 6.5%. And if the loan's owned by Fannie or Freddie and it's upside down, you can do a HARP loan. I think right now my clients are selling maybe 4.875. So you can take them from 6.5 down to 4.875, show them enough savings. This is just a good example of another list that's a good list to market to when rates are up. And this is just showing the counts of how many non-owner occupied HARP loans there are by state. That are Fannie or Freddie owned that we can guarantee calls on. So, this is a mail campaign where we offer a guarantee of a certain amount of calls, at $100 a call, but they're all super qualified Fannie Mae owned mortgages, qualified for HARP with the right dates. These are all 115 up loan amounts, paying higher rates. So just another campaign that we offer with, it's the only one we offer right now with a guarantee of a certain cost per call. So.
Great. Here's a sample letter that you're using. Anything specific on this letter that you wanted to point out to participants, Jeff?
Just that we're referencing their non-owner occupied property qualifies for HARP. So, obviously we mail the letter to their mailing address. but the letter references the property that they own that's in your state, with that particular loan amount. So, this letter was toned down a little bit. We're not quoting a mortgage payment on it, just showing a low rate, and that we can do up to 125% of the home's value. So talking about if their mortgage is upside down. So these are just a couple of HARP letters that we've done. That particular one was to non-owners, and this one's to owner-occupied, just people paying higher rates that are Fannie Freddie owned that we're still getting a good response on.
Well, you've got some tips here, Jeff, in terms of non-owner HARP direct mail call tips. Walk us through, as I bring these up, what you've learned from your experience in working with other clients on this issue.
Well, we track a lot of our clients' direct mail campaigns, so we know exactly how many calls come in. We record the phone calls, and we play back the calls just to see, who's qualified, who isn't, and try to make improvements. So, for me, I'm not just a mail house that's going to print and mail for you. There's plenty of people out there that can do that and do it real cheap. But my goal is to try to help my clients close more loans, and if I can give a little bit of training to help them when they take these phone calls to be more effective and get a few more loans funded, I can earn my keep type thing. So I've generated thousands of these phone calls and listened to calls. So I try to give some tips on, hey, here's how you can be more successful closing these leads. Put their loan officers through a little 20-minute training on just things that I've seen and heard. So, some of these tips were before we were verifying that the loan was Fannie Mae owned. So they'd have to look them up on the GSE or the different websites, the lookup tools for Fannie and Freddie, and it was important to get the correct name and address on these non-owners. Sometimes they would call and give us the wrong address because they don't live there, they don't remember the property address. So, pulling it up on title and making sure you're looking up the loan on Fannie Freddie's website with the correct address, the correct name. We've learned that if you use unit numbers on the Fannie Freddie lookup tools, a lot of times it won't recognize the unit number, so we leave that off. So, just tips to have a better close ratio on your calls. If it's get up on Fannie's website first, because Fannie owns 30% of the mortgages and Freddie only owns about 15%, so double the chances it's going to be Fannie owned. So we go Fannie first, then Freddie. If it's upside down and it's not Fannie Freddie owned, it's obviously a dead deal. Don't waste your time on it. But find out if they own any other properties, and then talk to them about their primary residence. A lot of these non-owners call about the non-owner occupied property, and then we find out, they're paying 5.5% interest rate on a 5-year ARM that's getting ready to adjust in the next few months. So they're a good candidate to refinance their primary residence. So talk to them about that. Get a Schedule E of the real estate owned for all their properties. Sometimes they own 10 different properties, and you could refinance 3 or 4 of them. Some are owned by Fannie, some Freddie. The average FICO score on these borrowers has been 740, so we haven't had credit issues. These investors are pretty savvy and pretty good credit. We get appraisal waivers on them through Fannie, running them DU, so that's been kind of nice, and you don't need the rental survey. So these are all things I've learned through working with all my clients. Borrowers are pretty savvy. They've done a lot of loans in their lifetime, so it's kind of a different phone call than maybe a first-time home buyer. See if they tried to go through their lender.
I got a question coming in from one of the panel or one of the participants about recommendations for other wholesale lenders or other people that are placing these types of loans. Do you have recommendations or like a tip sheet of different providers or wholesalers that some of your other clients are leveraging for these niche products?
I actually have a document called top HARP lenders with 20 different lenders on there that shows what states they're in and some of their niches, who will go unlimited LTV on non-owners Fannie, who will go unlimited on Freddie, and some of that's probably changed, but I do have a list if somebody wants a good HARP lender list to figure out, the top 20 lenders in the nation who's doing a good job. I can definitely send them to them, so they can just email me and I'll send them back my HARP lender list.
Great, and some of these tips can be emailed as well. So for the sake of time, I'll go ahead and show the remainder tips, and then if you'd like to get a copy of those, you'll get all the contact information following the webinar here. Anything else, Jeff, in terms of non-owner occupied HARP before we move on to close up the presentation?
That's really it.
Great. Well, talk to us a little bit more about next steps for marketing. We've got some simple steps here that are listed, but anything specific that you would recommend the participants today on the webinar can take advantage of?
Yeah, I mean, just best thing to do would be email me and let me know what states you're licensed in, and let me see how much data I have that fit all this criteria for FHA, for non-owner. I mean, depending on what you want to market, you might have to check and see what products you have available with your in-house lending, or if you're a broker, make sure you're signed up with lenders that can do, HARP on non-owners, unlimited LTV. So, let me know what states you're interested in. Let me pull up some data and send you some letter samples and just kind of start a conversation with that. So best thing is probably just to email me, and I'll respond right back with, some counts for your states, theirs that have been successful, and then set up maybe a conference call to go through the details.
Jeff, better to call or email? And I know we got over 45 people that are live on the webinar, maybe a little bit delayed in getting a hold of you by phone. You've got some other support team members that can get them back some counts. Would email be the best way to reach you after this webinar?
Yeah, I would say email me, and I'll send an email right back with some counts and letters, or one of my assistants will, and then my assistant Brian would get a hold of them and try to set up a conference call, so we have a set time for a call, because I'm definitely busy every day, but definitely looking to pick up some new clients and help them with their marketing.
Great. Well, thanks for your expertise, Jeff, and thank you for participating in this webinar, everyone. We look forward to having you get your own lead source becoming overflowed with new incoming opportunities. So check out overflowworks.com, or just send Jeff an email at jeffbush@overflowworks.com. Thanks, everybody. Have a great day.
Thanks.